So in effect, what I'm saying is that this area of personal versus occupational schemes works in a slightly different way in terms of the way in which tax relief is given. Yeah? For an occupational scheme, someone who's employed, the tax relief is given by deducting the contributions from the employee's employment income at source. So as the employee receives their monthly payslip, they will see a deduction for pension contributions. Outside of that, note on the employer's side, as mentioned up top, employers may make contributions, this is good news, not just for the employee, but also for the employer, because any contributions made by the employer into occupational pension schemes are tax deductible, okay? In other words, they're a bona fide business expense. Outside of that, certainly they are tax-free income for the employee. So this isn't a benefit, and in other words, in the normal sense of a benefit. Let's say, for example, that an individual is provided with a nice car, or living accommodation, or a flat screen TV. That's not exempt, but payments into an occupational scheme by an employer are exempt in terms of income for the employee, tax deductible for the employer. This is good news. So, outside of that, in terms of a pension scheme that is personal, what's the difference? Well, here as we said up top, we could have individuals who either are in an occupational scheme and want to top it up, in other words, have a personal pension too, or perhaps they're not employed, maybe they're self-employed, they just want to start a pension for their retirement. So in effect, this individual policy holder can actually claim income tax relief for 100% of their relevant earnings in the tax year. In other words, let's say for argument's sake, let's leave the definition of relevant earnings for the moment, we'll see it below. But let's just say that a person is self-employed and they have profits or taxable or total profits of, let's say, 100,000, taxable 100,000, whatever. They can contribute technically 100,000 in pension contributions into a personal scheme, okay, and get tax relief on the lot. Now, what do we mean by relevant earnings, okay? Now, this list needs to be earned. What we're seeing here is the revenue saying, yes, we're trying to encourage you to provide for your retirement, yeah? We're giving you tax relief as well, but at the end of the day, in terms of the max amounts that you can put in, it can't be more than the total of your relevant earnings. Employment income, trading profit, property income from, note, furnished holiday lettings, yeah? Not from, let's say, for example, ordinary lettings. This will become clearer once you see the property income chapter. Now, outside of that, in effect, the tax relief, is paid 20% at source, even if the policyholder is a non-taxpayer. So what does this mean? Well, this means that in a scenario where the individual is a basic rate taxpayer, so for argument's sake, let's say taxable income is 20,000, okay? In that scenario, this individual, if they have a personal pension plan, and let's say they contribute 5,000 gross, or they decide to opt for the Sun Life personal pension, and they contribute 5,000 gross, actually, all they'll need to contribute is 80% of 5,000, 4,000 in cash. So they pay out 4,000 to Sun Life. That's a pension company in the UK. What happens with the other 20%? Well, the government pay Sun Life. So you can see they're getting tax relief because they've created an asset on day one that's worth 5,000, but they've only paid 80 or 4,000 for it, 80%. So in effect, that's how basic rate tax relief works for personal pensions. Okay? Now, in a different scenario, let's say that the individual is not just a basic rate taxpayer. They're not earning 20,000, they're earning 80,000, 150,000. In this particular case, and we saw this before in relation to gift aid, the additional relief, so for example, the additional 20 for a high rate taxpayer is given by extending the basic and high rate bands, okay? High rate bands obviously for additional rate. So that may lose a little bit in translation right now. You may be thinking, what are you talking about, bands, yeah? I'm basically saying that within the income tax computation, an adjustment is made for the additional relief that they're due, because they are due a relief at their highest marginal rate. They had relief at source when they made the payment, let's say, earlier this month. But now we're producing the income tax computation. They need to get, let's say, as a high rate taxpayer, another 20%. So let's extend the bands so that more of their taxable income is taxed at 20% rather than 40. Okay? Now, here's the rub. We've talked about tax relief. We talked about the HMRC being nice, encouraging people to save for the retirement because the state pension isn't extremely large. Now, the annual allowance technically is the most an individual can save into their pension before having to pay tax, okay? Technically, okay? Now, what do we mean? Well, we mean that for our year, there's an annual allowance of 40,000, okay? Plus, note, any unused annual allowance brought forward from the 3 previous years, okay? So, what I'm saying is, yes, the annual allowance, the max amount before you have to pay actual tax, yeah, is 40, but you could have 3 lots brought forward if you haven't contributed in those years, okay? Now, in terms of this, let's say, hypothetical taxpayer with unused allowance, you know, they must make pension contributions in the current year of at least 40, plus the unused allowance of the earliest tax year if potential tax relief is to be maximised. Now, what we mean by that, in effect, is that there's a requirement, yeah, to make at least 40,000 in terms of a contribution. Okay? Now, what happens if things go pear-shaped? In other words, where you've got a situation where an individual actually pays more in than they should do, or more than the annual allowance, okay? Now, the initial annual allowance before any performance is subject to a restriction, yeah? It's subject to a restriction in relation to the taxpayer's adjusted net income. So in effect, what we're saying is, yes, there's a great regime in the UK, yeah? But there are issues or caveats or limits. One of them is in relation to the annual allowance, as mentioned above. The other is in relation to this high income area, okay? So what do we mean? Well, we mean that in this particular case, where we have income in excess of 240,000, that's quite a lot, yeah? It's reduced 1 for every 2, but only to a minimum of 4,000. So you can go, in effect, from 40 down to 4, okay? So, in effect, a taxpayer with adjusted income of, let's say, 270 would have allowance of 25 because 270 less the de minimis level, half of it, yeah, in effect, 15 taken off, okay? Now, taxpayers with income of 312 or more would have an allowance of only 4. So it only goes down to 4,000, not all the way to 0, okay? Quite a lot of information there. If you're looking at it and thinking, well, I haven't a clue, normal stuff. We'll just work the questions, we'll get better. Now, we touched on the annual allowance up top. I said max of 40. Okay, now, if the total pension input, if everything that goes into the pension in the year exceeds the allowance, including any unused amounts brought forward, remember, you can go back 3 years, yeah? The excess does not attract tax relief. So, in actual fact, what we're saying here is we've got an individual, okay? They're funding a pension, but you know what? They overdo it. They had 40 in this year. They had, let's say, for argument's sake, 40 from last year. They had 100,000, or they had 80,000. They contributed 100,000 into a pension scheme. Bad idea, because they're £20,000 over the value of their annual allowances, last year's plus this year's. So there's going to be a problem. There's a £20,000 excess. What happens with the excess? Here we go. Initially, relief is given for all contributions paid and indeed by the employer, but the excess is treated as additional taxable income charged at the individual's marginal rate. So in effect, what I'm saying in that scenario, this particular gentleman, let's say, contributed 100,000, had annual allowances in total of 80. So there's a £20,000 problem. That £20,000 is going to end up as taxable income. This is not good news. Don't overdo it on your annual allowances, yeah? Because you're going to end up with more tax to pay. Also, on top of that, there's a lifetime charge, okay? In other words, a potential penalty once you come to actually draw your pension at pensionable age. So, where a person retires, withdraws their pension benefits, and the benefits exceed the lifetime allowance, in other words, 1073100 for 23-24, any in excess of this will be additionally taxed, okay? So there, it's a double whammy. We've got the annual allowance problem, but then when you retire, you've also got a potential problem. So if it exceeds that amount, yeah, and indeed, if you're taking it as a lump sum, you've got several ways that you can take a pension these days when you get to retirement. But if you're taking as a lump sum, the excess will be taxed at 55. If you're taking it as an annuity or as a taxed annual amount, the excess at 25%. Now, again, as I say, I'm trying to sort of soften the blow here for you. All that we're saying in relation to pensions is, yeah, great idea, okay? The government encourages it. Several different types, occupational versus pensions, versus personal pension. Now, but there's a couple of things you need to be careful about if you overdo it, yeah? If you put too much into your pension fund, there's the annual allowance problem, and then there's the lifetime charge problem. So listen, take good advice. Be careful, because what you don't want is a situation where you've got more taxable income on your income tax comp than you anticipated, because in effect, that's a bit like a penalty, yeah? Okay, so next area for us, married couples. This area is fairly straightforward. Now, we're talking broadly here about planning, yeah? We're basically saying, okay, if couples are married, what sort of things are relevant to them, yeah? Well, I think what's relevant is each individual, as we said earlier on, is taxed separately. So they've got their own basic rate band, and indeed they've got their, in effect, the adjusted net income band, higher end, yeah? So in terms of utilizing, let's say that we've got a husband and wife for argument's sake. In terms of utilizing, yeah, and this is straightforward, this isn't complex, yeah, how would you utilize those bands just as they stand, yeah, in a tax efficient way? Well, first things first, if both spouses are working, they're obviously getting, for example, 2 lots of 37.7, yeah, at 20%, yeah. They're also getting 2 personal allowances. Outside of that, yeah, in terms of the division of ownership of income generating assets, be careful. So a simple example, let's just say that the wife works. She's a high earner, she's earning several hundred thousand, yeah. She's paying tax at 45% marginal rate. And they have a couple of properties as well, which they rent out. But those properties are in the wife's name. So the rental income and the rental profits are assessed on the wife at 45%. Let's say the husband is a stay-at-home dad looking after the kids. Well, I can tell you, split it into 2, because he has no income. In effect, he will have not just a personal allowance, but also a 20% band, i.e. our BRB, basic rate band, 37.7. So it would be crazy to have a division of ownership of property like that. And this is simple tax planning. This is not complex. This is simple. Organize your personal affairs so that income generating investments, and I just gave you one example of property, are split accordingly. So the husband owns 50%, the wife owns 50%. Okay? Now obviously there are practical implications as well. Perhaps when they married, the wife owned those properties. Maybe she doesn't want to do it. Well, that's up to her. We're talking about tax here. We're not talking about other areas or personal preferences. Okay, so outside of that, last point, sort of main point here is just transferable personal allowance. Basically, an individual can transfer 10% of their personal allowance to their spouse, okay? Provided that neither of them is a higher or additional rate payer, okay? So in effect, we're saying that there's the possibility where it's unused. Let's say your personal allowance is unused. You could, as a basic rate taxpayer, transfer it to your basic rate paying spouse. Okay? In terms of gifts to charity, we touched on those earlier on. Straightforward, payroll giving, or indeed, let's say gift aid. Nothing much to discuss there again. In terms of the high income child benefit charge, not covering that here. I'm making that self-study because again, I don't think it's a priority for us in this course, or indeed in the exam. Occasionally comes up, but it's not overly complex. I'm going to let you deal with it because we've got bigger fish to fry, as I keep saying. Okay? In terms of tax-free investments, pretty straightforward here. If you're going as a couple, let's say husband and wife, if you're going to really plan for your financial future, a couple of things you probably should be doing. Certainly individual savings accounts. Certainly trying to max out your pensions if possible. And maybe, although it's not a direct benefit to you, but there's a tax benefit in effect in your comp, the charitable donation route. Okay? So that concludes part 3. I hope you found that helpful, and indeed all parts. I've enjoyed this particular first chapter. I hope that you have. Don't worry too much, as I say.